Struggling regional lender New York Community Bank is receiving a, billion-dollar lifeline from several groups, including one involving former Treasury Secretary Steve Mnuchin. Joining us now is David Chiaverini. He's a managing director for Wedbush Securities that covers regional and mid-cap banks. So the question, of course, on everybody's mind is what's driving the concerns around NYCB, and should there be concern overall for customers who have their money in regional banks?
Yeah, so the main concern relates to the rent-regulated multifamily loan exposure in New York, where it's seeing significant stress. So investors are concerned about the coverage that the company has set aside to cover potential loan losses related to, these loans. So that's the main concern. Yesterday, midday, they announced a billion-dollar equity infusion. So that, takes some of the concern off the table, particularly for depositors. They did provide an update this morning saying that their deposits are down 4 billion from 81 billion to 77 billion. So down is not, good to see, but given how much the stock has been under pressure, 4 billion is less than feared in our view.
So, David, we should sort of remind people that, and you can correct me if I'm wrong, but this was the bank that kind of absorbed a lot of the assets from Signature Bank when Signature Bank got into trouble, and then it became a much bigger regional bank than it had been before. So then it was under additional scrutiny, and here we are. I want to ask you about the broader impact, but I want to ask you about something else. Office space, office leases, loans regarding that. As you know, a lot of people still have not gone back into the offices. The way we work has changed. Is that a factor in this case at all?
It is. So about 4% of New York Community's loan portfolio relates to office. And the good news in that regard is that they have set aside about 10% reserves to cover losses there. So even though office values are down, in the neighborhood of 50% in some cases, 10% seems to be a good level that a number of the banks are setting aside related to office. So that seems to be, well contained. It's really this, at least in our view, the rent regulated multifamily exposure that's a bigger problem. And they alluded to on a conference call earlier today that they plan to set aside a significant amount in coming quarters to cover those losses.
How have current interest rates played a role in how banks are operating?
Yeah, it's been a key factor in the stress because a lot of these borrowers took out loans at 3.5%, 3.75%, and now they're having to refinance at sometimes double that amount. And that debt service coverage ratio comes under pressure, and that's what's leading banks to offer lower principal amounts of loans than what they had previously. So that's what's putting stress on these borrowers because borrowers have to come up with the capital to support their properties.
So, people are going to see this headline and they're going to go, oh my gosh, I remember, Silicon Valley Bank and Signature Bank, and these are the small banks that lend to small business owners, and the bottom is falling out of the system. Is that the case? What's going on? Can we look at what's happening to this bank, and should we be concerned about other banks of similar size?
Yeah, so as of yesterday morning, it didn't look good for New York Community when the headline hit that they were seeking outside capital. The stock traded down, 40% down to below $2 a share. And then in the afternoon, when they put out a press release with this rescue package of over $1 billion, the stock, zoomed up, and today it's, doubled off the lows from yesterday. So it does seem as if this capital infusion has provided relief and should enable, New York Community to get through this. Yesterday in the morning, people were thinking that New York Community could go the way of Signature Bank and go into receivership with the FDIC, but it looks like that's off the table. And I would say that New York Community does seem to be an idiosyncratic situation given their abnormally high exposure to some of these higher risk loan categories that other banks don't have that similar exposure.
All right. David Chiaverini, thank you so much.
Thank you.